That's why Citadel's Scott Rubner says, talking about conviction among retail traders, it remains extraordinary that demand for call options has outpaced puts for 24 consecutive weeks. That ties with November 23, the longest streak ever. So he points to that. Now, the data only goes back to 2020, but nonetheless, it gives you a pretty good picture about where the bets are being placed in this market. The retail radar from J.P. Morgan tells a very similar story. Yes, we had an escalation in the trade war with China. You know, the president yesterday says, yeah, we're in one now. And obviously, Friday escalated things, and it caught the market a little bit by surprise, which is why you got the big sell-off that you did. However, imbalance, if you want to look at it that way, remains, according to the retail radar at JPM, robust. Plus $6.5 billion in terms of money coming in versus money coming out from retail. That already exceeds a strong year-to-date average of 6.4 for a couple consecutive weeks. Bill Baruch, to me, you are representative of both of those stats. You're representative of the point of view that I've articulated from the conversations that I've been having. They are representative of what I think we've heard on the desk already. You bought more SPY, okay, playing on the S&P, and you bought more of the IJR, which is the small cap ETF. Tell us more.
Yeah, we de-risked through the middle part of the summer. I thought the run-up was going to meet some seasonal headwinds, was going to meet some jargon around a potential Fed rate cut, and that hasn't happened. We trimmed that ETF basket. It complements our overall main portfolio that I discuss in the single names here all the time. And what I did was just get the rest of that cash to work in that main portfolio. So it represents about 10% of an entire 80-20 or an entire 60-40. So the SPY and the IJR, they sold off pretty sharply on Friday. I was really surprised to not see any follow-through to start this week, response against the 50-day moving average. And then we had Fed Chair Powell on Tuesday, who comes in and talks about an end game to QT. So I think right there you saw the Russell 2000 respond. The IJR is a little more slimmer of an index, and so we leaned into that. Potentially on the week you have a breakout in the small caps, so we'll see how the week finishes. And then as for the S&P, we're talking about valuations at the desk. If you look at relative valuations, which 40% of the S&P is 8 names, if you look at relative valuations, the Mag 7 is right in the middle of the range it's been over the last decade. So I don't think it's overvalued to some regard. But if we respond against the 50-day moving average as we have, and we're going to rally potentially, I want to make sure that ETF slice that we have in these portfolios is now fully allocated.
The no follow through from Friday's deep sell-off immediately reminded me of the guy in Airplane who pulls the plug on the runway lights for a moment, and then he's like, just kidding. and that's why over the weekend you got hey, all will be fine with China, and then the market, that's why the market rebounded on Monday the way it did.
What's so great is we now have these heat checks and these gut check instruments that trade 24/7 in the crypto markets, and it was an absolute slaughterhouse in the crypto markets Friday night into Saturday morning. It's recovered, not all the way since then, but that's where that risk-off appetite was being expressed with all of the publicly traded companies closed in the U.S. and Asia, et cetera. They go to the crypto market for liquidity and maybe to get negative on something, maybe to express a bet. That cycle plays out. That used to take a week.
Yeah.
We don't even need the stock market to be open to completely play that whole ballet out. And we're in the third act of the ballet by the time it's Monday morning and Trump is saying, don't worry about China. Yeah. It's amazing, the speed with which we price risk, reprice risk, and then put it back to where it was. And things that used to take a week or a month now only require a couple of hours.
Well, Bitcoin is actually off today, too. Speaking of it, it's back down. Futures are back at 108,000. So we've seen a lot of that recovery on the week now retreat. And just to remind you, too, we still have a lot of cash to get to work. We've trimmed in the main portfolios. They discuss the single names all the time. We have 8.5% to go. And we discussed it in the past. I took a cautious approach. This is just taking that step forward. But again, I am surprised. And crypto did fall out pretty sharply, as Josh talked about.
Carrie, I want to find out what these moves what view they express from you. You trimmed Amazon, Meta, and Alphabet, and here we are a week or so out from earnings. So what makes you want to do those moves before you even hear from these companies?
Most of the reason that we trim them is because they were so large as positions in our portfolios. So these are stocks that we've been overweight for years, and that overweight has expanded and expanded. And when you're running a portfolio that's diversified and you have positions that are close to 10%, I mean, they weren't at 10%, but you're getting it to the 8.5%, 9%. It's prudent to just reduce that when we look at just what's happened with the market, and also earnings growth is likely to slow somewhat. It's still going to be decent, but we've had such enormous gains in earnings over the last few quarters.
You just feel like you're just reducing a little bit of risk?
Yes, exactly.
But do you still expect you're going to hear good things from all these companies,
yes,
and you're just willing to have a little smaller position size than you did?
Yeah, plus if you sell something, you buy something else, and we put the money to work.
Oh, we'll get to, we'll get to that too.
That's why it didn't come out of the market. It went into other names.
I got you.